Welcome to the deep dive. Today, we're going to tackle value investing. You sent over a whole stack of articles and research papers, even some handwritten notes. Wow.
Yeah.
It seems like you're pretty serious about getting a solid grasp on this.
Well, it's a fascinating area, and it's more than just sort of hunting for cheap stocks. It's about understanding the true worth of a business.
Yeah.
Its intrinsic value, and then having the patience to wait for the market to kind of catch up.
Okay, so it's not just bargain hunting. There's a deeper philosophy at play here. What I find interesting is that value investing has been around for decades. Like, it's not a new concept,
Right.
yet it still seems to resonate with investors, even those MBA students who are supposedly all about the, latest financial models. What's up with that?
I think what's really intriguing is that despite being rooted in those classic principles, value investing has constantly evolved. You know,
Uh-huh.
From Benjamin Graham's focus on net nets to Warren Buffett's emphasis on durable competitive advantages. It's about adapting to changing markets, right? But staying true to those core principles of buying assets for less than they're worth.
Yeah, that evolution is key, right? It's not just dusting off Graham's security analysis and calling it a day.
Right,
We need to understand how those principles apply in today's market.
right, exactly.
Speaking of Graham, one of your notes mentions a quote from the first edition of Security Analysis, something about many shall be restored that now are fallen.
Oh, yeah. The full quote is, many shall be restored that now are fallen, and many shall fall that are now in honor.
Wow.
And I think it beautifully captures, the cyclical nature of markets and the idea that sentiment often swings to extremes. Value investors, they look for those companies that have, fallen out of favor, those fallen angels, betting that the market will eventually recognize their true worth.
So it's about being contrarian, going against the herd, but isn't there a risk in assuming the market's always wrong? How do value investors avoid those value traps, companies that are cheap for a reason?
Yeah, that's where the, careful analysis comes in. Value investors don't just look at the price. They dig deep into the financials, the industry dynamics, the management team. They want to understand why the market is undervaluing the company and whether those issues are, temporary or terminal.
So it's like being a detective uncovering clues that the market might be missing. You also mentioned Warren Buffett. I noticed one of the articles you sent focuses on his acquisition of See's Candies back in 1972.
Yeah.
It seemed like a, pretty simple business, chocolates, candy shops, but obviously Buffett saw something special there. What was it?
What Buffett recognized was the power of See's brand and its, loyal customer base. It wasn't just about selling candy. It was about selling an experience, a tradition. People weren't just buying a box of chocolates. They were buying a little piece of nostalgia.
So he was buying a franchise, a business with a durable competitive advantage. But how do you actually identify those franchises, those companies, with a lasting edge?
Well, there are several factors to consider, but customer captivity is crucial. Think of those companies that have a way of keeping customers coming back for more, whether it's through brand loyalty, habit, high switching costs, or combination of factors.
Can you give me an example? What would be a company with strong customer captivity today?
Well, think about a company like Costco. Their membership model creates a sense of exclusivity and value, encouraging customers to spend more, to stay loyal. And they've also built a reputation for, quality products at low prices, making it hard for competitors to really match that value proposition.
Costco. Yeah, that makes sense. Walk in for a gallon of milk, walk out with a kayak and a year's supply of paper towels. Their business model seems pretty resilient. Okay, so we've got the historical context, the basic philosophy, and the concept of competitive advantages. But how does all of this translate into actual investment decisions? How do value investors find those opportunities where the market is mispricing a company?
One area they often look at is small cap stocks, those companies with smaller market capitalizations that tend to get less attention from, Wall Street analysts and institutional investors.
So they're looking for those under-the-radar companies that might be overlooked by the big players.
Exactly. There's less competition. Often those, smaller companies can grow much faster than their larger counterparts, creating the potential for outsized returns.
Okay, small cap stocks are one area to focus on. What else? I remember you mentioning spin-offs as another potential source of opportunities. Can you explain that a bit more?
Sure, a spinoff occurs when a larger company divests a division or a subsidiary, creating a new independent company. Often these spinoffs get overlooked by, institutional investors because they might be too small for their portfolios, or they might not fit neatly into, a particular industry classification.
So it's like finding hidden treasures that the market is ignoring or miscategorizing. But how do value investors know if a spinoff is actually a good investment opportunity?
Well, they dig into the financials, the management team, the competitive landscape of the newly formed company. Just like they would with any other potential investment, they're looking for those spin-offs where the market is undervaluing the assets, the earnings power, or the growth potential of the business.
So it's about applying those same principles of value investing, but to a specific subset of companies that often fly into the radar. What I find fascinating is that value investing isn't just about analyzing spreadsheets and financial statements.
Right.
It's also about understanding human behavior, how our emotions can lead to those mispricings in the market.
Yeah, that's where behavioral finance comes in. It challenges the idea that investors always act rationally and recognizes that we're all susceptible to biases like overconfidence, herd mentality, loss aversion. These biases can create opportunities for value investors who are able to stay disciplined and objective in their analysis.
Can you give me a real-world example of how these behavioral biases might create an opportunity for a value investor?
Sure, imagine a company announces a disappointing earnings report. The market overreacts, sending the stock price plummeting. A value investor might see this as an opportunity, recognizing that the market's fear has driven the price down too far, creating a disconnect between price and intrinsic value.
So they're buying when others are fearful, taking advantage of that emotional overreaction. But how do they know that the company's problems are temporary and not a sign of deeper issues?
Well, that's where the detective work comes in. They analyze the financials, the industry trends, the management's response to the challenges. They're looking for evidence that the company has a plan to address the issues and that its core business is still strong.
So it's not just about buying cheap stocks. It's about buying undervalued businesses with the potential for recovery or growth. This is all starting to make sense. But before we dive deeper into those specific valuation techniques, I want to make sure we're all on the same page about what value investing isn't.
Mm-hmm.
It's not about chasing momentum or trying to time the market, right?
Exactly. Value investing is about understanding the fundamentals of a business, its intrinsic worth, and then buying it at a price that offers a margin of safety. It's a long-term approach, requires patience, discipline, and the willingness to go against the crowd.
That long-term perspective is key, isn't it? It's not about trying to get rich quick. It's about building wealth gradually, brick by brick, by investing in solid businesses at reasonable prices.
That's right. And one of the most important aspects of that long-term approach is understanding those durable competitive advantages,
Right.
those moats that protect a business from competition and allow it to generate consistent profits over time.
Okay, so moats are essential, but they're not static, right?
Right.
Industries change, technologies evolve, consumer preferences shift. How do value investors assess the durability of a company's competitive advantage in a world that's constantly in flux?
That's a great question. And it leads us to, one of the most challenging aspects of value investing, the analysis of those intangible factors that don't always show up neatly on a balance sheet. We'll delve into those nuances in more detail in the next part of our deep dive.
This is all so fascinating. I can't wait to explore those intangible factors and really understand how to identify those companies with a lasting edge.
Yeah, it's a crucial part of the value investing puzzle. And, it's where art meets science. We'll unpack those concepts and provide some real-world examples that will hopefully give you a clear picture of how to apply those principles to your own investment decisions.
Great. I'm ready to dive deeper.
Okay.
All right, so before we dig into the nitty-gritty of valuation, I want to pick up on something you mentioned at the end of the last part. Those intangible factors that contribute to a company's competitive advantage. Feels like we're moving beyond balance sheets and income statements now into like more qualitative territory.
Exactly. We've talked about things like brand loyalty and switching costs, but there's a whole layer of, less tangible factors that can make or break a company's long-term success.
Okay, I'm intrigued. Give me an example. What kind of intangible factor are we talking about?
Um, let's take management quality. You can't really quantify it on a spreadsheet, but a strong, ethical, and forward-thinking management team can make all the difference. They set the tone, the culture, the strategic vision for the company.
So it's about looking beyond the numbers and assessing the leadership, their track record, their ability to adapt and innovate. How do value investors actually go about evaluating management quality? Is it all gut feeling, or are there like more concrete things they look for?
Well, it's a mix of art and science. You can look at their, past performance, their capital allocation decisions, how they've communicated with shareholders, during good times and bad. But it also involves, reading between the lines, understanding their motivations, their long-term vision for the company.
So it's about getting a sense of their character, their integrity, their commitment to building a sustainable business. One of the articles you sent mentions Warren Buffett's famous quote, "I try to buy stock in businesses that are so wonderful that an idiot can run them because sooner or later one will."
Right. Right. Well, that quote, it highlights the importance of a business that can essentially run itself, you know,
Yeah.
with systems and processes in place that are resistant to mismanagement. But even with those, wonderful businesses, a skilled and visionary leader can take things to a whole nother level.
So it's about finding those companies that have a strong foundation, but also the leadership in place to capitalize on opportunities and navigate challenges. Okay, management quality, I get it. What other intangible factors should value investors be paying attention to?
Another crucial one is company culture, a strong culture, one that aligns with the company's values and fosters innovation, can be a powerful competitive advantage. You can attract and retain, top talent, drive customer loyalty, and create a sense of purpose that goes beyond just making profits.
Culture. That's a tough one to measure, isn't it? It feels almost like a vibe, an energy you sense when you interact with a company and its employees.
It can be, subtle, but there are ways to assess it. Look at employee turnover rates, how the company treats its customers, how it interacts with its community. Read online reviews, talk to employees, get a sense of whether the company walks the talk when it comes to its stated values.
So it's about doing your due diligence, not just on the financials, but on the human side of the business. We talk a lot about competitive advantages in business, but it strikes me that these intangible factors like management quality and culture are almost like competitive advantages in life as well.
Hmm?
They can make or break a team, a project, a relationship.
That's a great observation. I think, these principles of value investing, these ways of thinking about value and risk, they can apply to so many aspects of life.
It's about making informed decisions, considering the long-term implications and understanding that value isn't always immediately apparent. Okay, so we've got these intangible factors added to our toolkit. Now, how do we actually apply all of this to the valuation process? How do we go from these qualitative assessments to a concrete number that tells us whether a company is worth buying?
Right. Well, we've touched on those three key elements of intrinsic value, asset value, earnings power value, and growth value. Let's dive a bit deeper into each of these and see how they can, help us build a more complete picture of a company's worth.
Sounds good. Let's start with asset value. It seems pretty straightforward. What are the company's assets actually worth? But I imagine it's more complicated than just looking at the numbers on a balance sheet.
You're right. Remember, the balance sheet is just a snapshot in time, and the book values of those assets might not reflect their true market value today.
Okay, so we need to adjust those book values to reflect current market conditions. How do we go about doing that?
It requires some digging and some educated assumptions. For real estate, you might consult with appraisers or look at comparable properties in the market. For equipment, you might consider replacement costs or option values.
So it's about getting a realistic assessment of what it would cost to rebuild the company's asset base today. But what about those intangible assets like brands, patent, or customer relationships? Those don't really have a physical form, so how do you value them?
Yeah, that's where things get, tricky. Intangible assets can be incredibly valuable, but they're also, difficult to value with precision. There are different methodologies, but it often involves estimating the future economic benefits that those intangible assets are expected to generate.
So it's about projecting those future cash flows, those earnings that those intangible assets are expected to contribute to the business. But isn't that incredibly speculative? How can you accurately predict the future?
Well, you can't predict the future with, certainty, but you can make reasonable assumptions based on historical data, industry trends, and the company's competitive position. And remember, value investors always demand a margin of safety, so they build in a buffer to account for those uncertainties.
The margin of safety, that's like our insurance policy against those unexpected twists and turns that life throws our way. Okay, so we've got asset value, both tangible and intangible. What about earnings power value, or EPV?
Yeah, EPV focuses on a company's current earnings and its ability to generate profits on a sustainable basis. We start by looking at the income statement analyzing the company's revenue streams, its cost structure, and its operating margins.
So we're trying to get a sense of the company's core profitability, how much money it's making from its day-to-day operations.
Exactly. But we also need to, adjust those earnings to reflect a normalized level of profitability.
Normalized profitability. What do you mean by that?
Well, it means, smoothing out the bumps, removing any one-time gains or losses, any unusual expenses or accounting distortions that might have impacted the reported earnings. We want to get a clear picture of what the company can earn on an ongoing basis without those temporary fluctuations.
So we're stripping away the noise to get to the signal, the underlying earnings power of the business.
Precisely. And once we have those normalized earnings, we can apply a capitalization rate to determine the EPV.
A capitalization rate. Can you break that down for me? What does that represent, and how do we determine the right one to use?
Well, it's essentially a discount rate that reflects the riskiness of those future earnings. The higher the risk, the higher the capitalization rate, and the lower the EPD.
So it's about adjusting for the uncertainty of those future earnings. A company with a more stable and predictable earnings stream would have a lower capitalization rate and therefore a higher EPV, right?
Exactly. And determining that capitalization rate is a mix of art and science. It involves considering factors like the company's industry, its competitive position, its financial health, and the overall economic environment. You know, experienced value investors develop their own frameworks and judgment based on years of analyzing different businesses and industries.
So it's not a simple plug and play formula. It requires experience, judgment, and a deep understanding of the factors that drive a company's earnings power. Okay, so we've got asset value and earnings power value. Now let's tackle the big one, growth value. This is where things get really tricky, right? We're essentially trying to put a price tag on something as unpredictable as the future.
It is the most challenging aspect of valuation, but it's also where the potential for outsized returns often lies. Remember, growth only creates value if it's profitable growth. If a company's reinvesting its earnings at rates of return that are lower than its cost of capital, it's actually destroying value.
So it's not just about growing for the sake of growing. It's about growing in a way that creates value for shareholders. How do value investors actually assess the potential for profitable growth?
Well, they start by analyzing the company's industry, its competitive landscape, and its track record of innovation. They look for companies with a history of generating high returns on invested capital, those that have shown the ability to allocate capital effectively and create value for shareholders.
So it's about finding those companies that are not only growing, but growing in a smart and sustainable way.
Exactly. And it's not just about, looking backward. It's also about looking forward, assessing the company's growth opportunities, its potential to expand into new markets, to develop new products, to gain market share.
So it's about understanding the company's strategic direction, its vision for the future, its ability to adapt and evolve as the market changes. But how do you translate all of that into a concrete number, a dollar value for that future growth?
There are different approaches, but one common technique is to project future earnings based on reasonable assumptions about the company's growth rate, its profitability, and its reinvestment opportunities.
So you're building a financial model, a picture of what the future might hold, but those projections are based on assumptions, on educated guesses about what might happen. How do you account for the inherent uncertainty of the future?
Well, value investors are inherently conservative. They're not trying to predict the future with perfect accuracy. They're trying to build in a margin of safety to protect themselves from those inevitable surprises. They use conservative growth rates. They discount those future earnings at a relatively high rate, and they demand a substantial discount to their estimated intrinsic value before they'll even consider buying.
So it's a layered approach to risk management, recognizing that the future is inherently unpredictable and building in those buffers to protect against those unknowns.
Exactly. And it's important to remember that growth value is the most subjective and the most uncertain element of valuation. Even the most experienced value investors get it wrong sometimes. The key is to be humble, to recognize the limitations of our predictions, and to always demand that margin of safety.
This has been incredibly helpful in unpacking those different elements of valuation. But I'm curious, how do these legendary value investors, those with, decades of experience and countless successes, how do they actually apply these principles in the real world? Do you have any examples that can bring this all to life?
Absolutely. Let's look at a few case studies that illustrate how these principles have been applied in different industries and market conditions.
Perfect. I'm eager to hear those stories and see how these concepts play out in practice. All right, we've covered a lot of ground from the philosophical underpinnings of value investing to the nitty-gritty of valuation. Now I'm really eager to hear how those legendary investors we've been talking about put these principles into practice.
Yeah, it's, one thing to understand the theory, but seeing it in agonin is what really brings it to life. Let's start with an example from the world of consumer goods. Warren Buffett's acquisition of Gillette back in 1989.
Gillette, the razor company. I wouldn't immediately think of razors as like a classic value investment. Seems like a pretty mundane product.
That's the beauty of value investing, right? Finding those hidden gems in seemingly, ordinary places. Buffett saw something special in Gillette, a dominant market share, a strong brand, and a product that people need and buy repeatedly. It's the classic razor and blades model where that initial purchase is just the beginning of a long-term customer relationship.
So he wasn't just buying a razor company, he was buying a cash flow stream, a recurring revenue model that would generate profits for years to come. But how do you value that kind of predictability, that customer lock-in?
Well, it goes back to those principles we discussed earlier. Earnings power value and growth value. Gillette had a proven track record of generating consistent profits, and Buffett saw the potential for continued growth as the company expanded into new markets and product categories.
So he was looking at those historical earnings as a base and then projecting that growth into the future, factoring in those competitive advantages that would allow Gillette to maintain its market dominance.
Exactly. And remember, Buffett is known for his patience, his willingness to hold investments for the long term. He wasn't betting on a quick turnaround or a short-term spike in the stock price. He was investing in a company that he believed would continue to generate value for decades.
That long-term perspective is crucial, isn't it? It takes the pressure off trying to time the market or chase those fleeting trends. Okay, so we've got Gillette, a classic example of finding value in a seemingly mundane product with a strong recurring revenue. Do you have another example, perhaps one that illustrates a different type of value investing opportunity?
Sure. Let's shift gears to the world of financial services and look at Seth Klarman's investment in Capital Cities ABC back in the 1980s. This wasn't about finding a beaten-down asset. It was about recognizing the potential for value creation through a strategic acquisition.
Capital Cities ABC, that rings a bell. Wasn't that the company that eventually merged with Disney?
Exactly. Klarman saw that Capital Cities, a well-managed and profitable company, was undervalued by the market. He believed that the company's strong management team and its focus on operational efficiency would create significant value if it could acquire a larger asset, a company with greater scale and reach.
So he wasn't just looking at the company's current financials. He was looking at its potential, its ability to generate even greater profits through a strategic acquisition. That takes a lot of foresight, a lot of confidence in your assessment of management's capabilities.
It does, and it highlights the importance of qualitative factors in value investing. Barman wasn't just crunching numbers. He was assessing the leadership, the culture, the company's ability to execute on the complex transaction.
So it's that combination of quantitative and qualitative analysis that gives you a more complete picture of a company's potential. Okay, Capital City is a great example of finding value through strategic acquisitions. Do you have one more example, perhaps one that showcases a different aspect of value investing?
Sure. Let's move to a more recent example, one that highlights the opportunities that can arise in times of market turmoil. In 2008, during the depths of the financial crisis, a young hedge fund manager named David Einhorn saw an opportunity in a company called Allied Capital.
Allied Capital, wasn't that a business development company, one of those firms that invest in smaller private companies? It seemed like a pretty risky bet during a financial crisis.
It was Allied Capital's stock price had plummeted as investors worried about the company's exposure to risky loans and investments. But Einhorn dug deep into the company's financials and came to a different conclusion. He believed that the market was overreacting to the perceived risks, and that Allied Capital's assets were actually worth significantly more than the stock price reflected.
So he was betting against the crowd, seeing value where others saw only danger. That takes a lot of courage, especially during a time of such widespread fear and uncertainty.
It does, but that's often when the best opportunities arise. When the market is driven by fear, not fundamentals. Einhorn's investment in Allied Capital turned out to be a huge success, generating a multifold return for his investors.
These examples are so inspiring. It's amazing to see how these value investors with their diverse styles and approaches all share that same ability to see value where others don't. But we've been talking a lot about legendary investors, those with years of experience and massive portfolios. What about the average investor, someone just starting out? Can they really apply these principles of value investing to their own portfolio?
Absolutely. Value investing is a philosophy and that of principles that anyone can apply. You don't need a Wall Street pedigree or a billion-dollar hedge fund to be successful.
So what advice would you give to a new investor who wants to start applying these principles? Where should they begin?
Well, the first step is education. Read the classics, Security Analysis by Graham and Dodd, The Intelligent Investor by Benjamin Graham, the Letters to Shareholders from Warren Buffett. These books will give you a solid foundation in the principles of value investing.
So it's about understanding the theory, the philosophy behind the approach. But what about the practical side of things? Where do you actually find those investment ideas, those companies that might be undervalued by the market?
Well, there are many ways to generate ideas. You can start by looking at the companies you already know and use, those that you understand and admire. Read industry reports, follow financial news, talk to people in different industries. Keep your eyes and ears open for those businesses that might be flying under the radar.
So it's about being curious, about exploring different industries, about looking beyond the obvious. But once you've identified a potential investment idea, how do you actually go about analyzing it? That valuation piece still feels like the most challenging part.
Well, it's where the rubber meets the road, but it's not as, daunting as it might seem. Remember those three key elements of intrinsic value we discussed. Start by analyzing the company's assets, its earnings power, and its growth potential. Use those principles as a framework, but don't be afraid to adapt them to the specific circumstances of the company you're analyzing.
So it's about applying those principles, but also using your judgment, your common sense, your understanding of the business and its industry.
Exactly. Value investing is not a rigid formula. It's a flexible framework that you can adapt to different situations. And as you gain experience, as you analyze more companies, you'll develop your own style, your own approach to valuation.
This has been incredibly insightful. I feel like I have a much deeper understanding of value investing, not just the mechanics of it, but the philosophy, the mindset, the long-term perspective that's so essential to success.
Well, I'm glad to hear that. And remember, value investing is a journey, not a destination. There's always more to learn, more to explore, more opportunities to discover.
So keep reading, keep learning, keep asking questions, and most importantly, keep your eyes open for those hidden gems that the market might be overlooking.
Exactly. And as you embark on your own investment journey, remember the words of Warren Buffett: price is what you pay, value is what you get.
That's a great reminder to focus on the long term, to seek out value and to always demand that mark of safety. Well, on that note, I think we've reached the end of our deep dive into the world of value investing.
It's been a pleasure exploring this fascinating topic with you.
I've learned so much, and I'm sure our listeners have too. Thanks for joining us on this deep dive.